Good afternoon, everyone, and welcome to the Revolving Loan Fund Close webinar. My name is Taryn Rathman from WEC, and I will be the moderator for today's session. Before we get started, I'd like to go over a few items so you know how to participate in today's event. Each of you should see a control panel on the right side of your screen. You can expand and collapse the panel by clicking on the orange arrow. By default, you've joined the presentation listening using your computer's speaker. If you would prefer to join over the telephone, just select phone call in the audio pane of the control panel and the dial-in information will be displayed. All attendees have joined the webinar with their audio muted. You can submit questions to our presenter at any time using the questions pane of the control panel. Simply type your question and submit it. Our presenter will answer your questions as soon as possible throughout the webinar. Please note that we will be emailing a PDF version of the PowerPoint presentation to all the attendees following the webinar. And with that, I'd like to turn things over to today's presenter, Dave Polish.
Good afternoon, and thank you for joining our webinar related to the Community Development Block Grant Economic Development Revolving Loan Fund. We're going to be providing updates today and a webinar presentation that we've actually been providing throughout the state of Wisconsin at our regional meetings. So really our intended audience today is for those individuals that weren't able to attend any of the regional meetings or haven't had a in-person visit by us. So again, I'm Dave Polish, Bureau Director for the Bureau of Community Development within the Division of Energy, Housing, and Community Resources. I'll be joined today by Mark's staff, our section chief within the Bureau, and Mark and I administer the Community Development Block Grant program housed within the Department of Administration. So again, we'll go through this presentation. It's about 25-30 minutes, and we'll take questions at the end or as we're going. Feel free to type those in, and we'll have those questions addressed as we move forward through the presentation. So we're going to begin with a program history of the compliance with the Community Development Block Grant Economic Development Revolving Loan Program, and then also go through the proposed closeout program. So to start with today's overview of the Community Development Block Grant Program, President Trump has twice tried to zero out the CDBG program in proposed budgets, and twice Congress has responded by restoring the funding to the program. And within this last budget cycle, they actually increased the funding for the CDBG program by 10%. HUD wants to show Congress that continued CDBG funding is critical to states and the communities within our state that benefit from the CDBG dollars. In order to do that, communities within the state that have CDBG dollars have to report on the progress of their projects, the beneficiary data, and so we can document to Congress that the funds are being used effectively at the local level. So HUD officials are concerned that many states, not just Wisconsin, currently have significant CDBG dollars and revolving loan funds that are not being used in their communities. Within the state of Wisconsin, the CDBG Revolving Loan Fund program totals about $100 million in capitalization. Over the last reporting period that was submitted back in September of 17, over half of that funding is cash on hand and not revolving. So approximately $55 to $60 million is sitting in cash on hand within banks. So to further expand on the program history, in 2012, the Washington Post ran a story that was critical of the home and CDBG programs, and that led to increased scrutiny by the Office of Inspector General. And they're the law enforcement arm within HUD, which wants to make sure HUD and their subgrantees are following all the federal rules and regulations. So again, that scrutiny was placed upon the state, not just Wisconsin, but all over the nation, looking at economic development programs and also then drilling down towards the revolving loan funds. In March of this year, Sarah Bushman, our division administrator, and I attended a national conference of state CDBG programs, and HUD staff informed the states that the Office of Inspector General would be turning their focus on revolving loan fund programs beginning in 2018. So some of the history is OIG, the way they've operated is they kind of look at subsets of the CDBG program and all the programs that they oversee. Recently, they were looking at acquisition relocation projects, which we had the unfortunate occurrence where they looked at some of our projects related to that, and it's never fun to work with the Office of Inspector General. But now that they've kind of wrapped up that activity, now they're looking at the revolving loan fund programs. So we were strongly encouraged by HUD staff to review and tighten up RLF programs and look at them closely to make sure that they are all compliant with all the federal rules and regulations. Many states have already discontinued use of CDBG dollars for economic development projects due to that ongoing complexity in overseeing the local revolving loan funds. And interestingly, quite a few states actually never have done economic development projects with their CDBG dollars because of the complexities of all the rules and regulations. So stepping back again in 2012, HUD monitored the state of Wisconsin's economic development program and issued a number of findings. And since that time, we've worked diligently to obtain accomplishment data such as the job creation and low to moderate income benefit information and to close out those old projects. That's something that wasn't being done for many years, where projects weren't closed out in the federal tracking system. So all that documentation we've attempted to compile that, make sure projects were compliant with all the federal rules and regs, and that jobs were created and that low to moderate income benefit was obtained for those economic development projects. So again, we are addressing the audit findings. That included state repayments to HUD and grant reductions. So in 2015, the state was determined to be liable for approximately $15.2 million of failed economic development projects, and the state addressed those by half of that amount was paid back with general purpose revenue through the state budget, your tax dollars, to refund for these failed economic development projects. The other half was also done through a one-time grant reduction in our annual allocation from HUD. HUD again in 2017 monitored our economic development program looking at old economic development projects. And they followed up that monitoring in 2017 with another visit this spring in May. So we're currently awaiting the monitoring results from that, but we've been given information that several findings will be made, and then those findings are going to also include information and improvements that they would like to see in the oversight of the state's economic development revolving loan fund program. So we all understand that the revolving loan fund for economic development program is very challenging. There's over 130 locally held revolving loan funds. And many of those funds make very few loans per year or no loans over several years. Many RLFs don't routinely and consistently revolve their money, or they don't generate enough program income to revolve them, make additional loans. It's just not enough activity. And HUD's expectation is that the funding revolves every 12 months. So we know a lot of revolving loan funds are non-compliant with HUD's expectations. Local governments are supposed to have the capacity and knowledge to operate their program in full compliance with HUD rules and regulations. It's our role as the state to monitor that compliance with the federal rules and regulations. We understand that many local governments have challenges to correctly administer the RLF programs, and that's due to a variety of reasons. It could be turnover with staff at the local level, just the complexities and the time allocation that it takes to follow the rules and regulations at the federal level. It's very challenging. So HUD's aware of our compliance issues within Wisconsin, and they've informed us that we'll be receiving a number of findings related to the RLFED program. If we keep the RLF program open, we feel there's significant risk for local communities that continue to remain that either HUD program staff or HUD OIG would deem projects that were not revolved in accordance with all regulations and guidelines. So if that were to happen, the penalties could be significant. Similar to how the state was required to make repayments to the CDBG program, local communities could also be held responsible for those loans that don't have documentation, that all the rules and regulations were filed, or the national objective criteria was not met for their projects. So back when we were out in Washington, D.C. in March, HUD referred us to take a look at an RLFED closeout program that was recently created in Illinois. Illinois faced similar situation as Wisconsin, where they had a lot of RLFs that were not revolving their funds, and they lacked the documentation to document the projects were completed that met a national objective. So they had all the same issues that we currently have in Wisconsin. So we've submitted a substantial amendment to HUD through our comprehensive plan to create an RLF-ED closeout program similar to Illinois. We feel we've made a few tweaks in that to make it more flexible, increasing that ability for our local communities to still advantageously use these CDBG dollars. A major benefit of the closed program is it creates flexibility that currently does not exist in the RLF program. And by flexibility, we mean currently your RLF program can only fund economic development activity. Through the closed program, we're going to be able to open that up, re-grant money to the local municipalities for use for any eligible CDBG project. In addition, revolving loan funds that were capitalized prior to 1992 can be deemed defederalized if the local unit of government can certify that they have not received any post-1992 economic development awards. And Mark will explain that in more detail further on in the presentation, but we will be working with communities to certify that that is the case. Under our CDBG closed program, funding returned to the state will be allowed to be used by communities for any eligible CDBG project. So when we talk about CDBG projects, they also must meet a national objective. And the two national objectives that will be the primary focus of the reutilization of closed dollars include the low and moderate income national objective and the slum and blight national objective. To meet the low and moderate income national objective, you can go through a different variety of doors, if you will. One is area benefit. If you're proposing a public infrastructure project that has a benefit to the entire community and your community is greater than 51% low to moderate income persons residing there, that project would be eligible for a closed grant. You could also go through the limited clientele alternative, and that could be, let's say, a senior center. Seniors are presumed to be low to moderate income, therefore they're a limited clientele, and a senior center project would meet that low and moderate income test. Housing projects that result in the reestablishment or conversion of buildings into low to moderate income housing are also eligible to be used to meet the low to moderate income national objective. Jobs programs such as economic development awards are also another way to meet the low and moderate income benefit test. A job creation project such as granting funds to a business that creates jobs, and 51% of those jobs are ultimately held by low to moderate income persons, that would also meet the low to moderate income benefit national objective. Slum and blight, a second national objective, can be met in a variety of ways, one being area basis. So if you have a downtown redevelopment district and the community has gone through the process to determine that as a blighting influence, funds could be utilized within that area to eliminate blight and meet the slum and blight national objective. Spot basis refers to a community that may have just an individual building where that building is blighted and they want to address that by either the rehabilitation of the building or the acquisition and demolition of that building. That would also meet the slum and blight national objective. So this is just an example. Again, there's a lot of misconception out there with our communities around the state that have revolving loan funds. A lot of times they feel that if they're not low to moderate income based on census data as a community as a whole, they're not eligible to use their dollars within their community, and that's not the case. Communities can look at a sub area of their community, such as doing, let's say in the example that's provided right now, a 2-block stretch of Wisconsin Street. If you're just doing the street, sewer, and water within that block, that benefits the households that are adjacent to that project. And if those households, you would perform an income survey on those. If the income survey determines that 51% of the residents on those 2 blocks that are adjacent to Wisconsin Street are low to moderate income, that project would be an eligible use of CDBG dollars. So you don't necessarily have to be an LMI community as a whole to utilize these dollars. Other eligible projects, so really public infrastructure projects, again, that have that benefit of 51% for LMI persons, roads, sewer, water projects, fire stations, community centers, libraries, wide variety of projects can be utilized or can be utilizing these dollars. Housing projects, again, conversion of existing buildings into low to moderate income units, eligible use of the projects. We cannot do new construction, but again, conversion or rehabilitation of existing buildings is eligible. You can address a new housing project, but the CDBG dollars could only be used for, let's say, the acquisition or soft costs associated with that project. They couldn't be used for the actual construction of a new building. Planning projects that meet a national objective are also eligible, such as redevelopment plans, workforce housing studies, Those are eligible projects that we're seeing applicants apply for, as well as redevelopment projects such as a downtown redevelopment district, upgrade of or update of comprehensive plans in low to moderate income communities. That's also an eligible use of the dollars. Public service projects are a new category. The state has not utilized their CDBG funds for in the past, but we felt it's important to have this option out there for communities to use. The establishment of job training programs where the trainees, at least 51%, are low to moderate income. If it's a new program, that's an eligible use of the dollars. Operation of food pantries, opioid treatment centers. As long as it's a new service, it's an eligible use for public service projects. And again, as I mentioned earlier, economic development grants or public facility for economic development grants are also an eligible use as long as 51% of the jobs created by those projects are held by low to moderate income persons. Another benefit of the CDBG Close program is that there's no matching fund requirements when these funds are returned to the community. They're non-competitive and can be applied for at any time for up to 2 years. So again, providing that flexibility, dollars returned to the state under the revolving loan fund close program are granted back to the community with no matching fund requirement, non-competitive, and can be applied for a 2-year period once the project once the program is started. So how will this work? At this time, I'm going to turn it over to Mark's staff, and he's going to go through the details of how the closed program works.
All right, thanks, Dave. And it looks like we did have one question in the queue. And so the question was, what will happen with any surplus funds after the 2-year period? So if a community isn't able to use their funds that have turned in within a 2-year period, then those will be reutilized in our current state programs for any eligible project throughout the state. So instead of just being held specifically for your community, they will go back into our programs for a statewide benefit. Again, if you have any questions, feel free to ask them during, and there will be a time for questions at the end. How will this work? So the state has submitted a substantial amendment to the comprehensive plan to create the closeout program. Every 5 years, the state has to submit a comprehensive plan to HUD explaining how we're going to spend our dollars during that 5-year period. Any deviation from that plan requires a substantial amendment. And this closeout plan, since it's new, did require the substantial amendment be filed, and that was submitted to HUD on August 3rd. Upon receiving approval from HUD, the state will establish a start date. This slide is, well, the next sentence at least, the target start date being October 1st. That is no longer accurate. Even if we received approval from HUD later today or tomorrow, we are going to be pushing back that start date. We aren't sure when. We are thinking that we'd like to give at least a minimum of 30 days notice from when we do get that approval from HUD before we do establish a start date. So potentially still November 1st or December 1st. We would really like to start no later than January 1st of the new year. But again, that will be determined from when we do receive that approval from HUD, and still waiting for that. So at the time the program starts, again, whenever we do establish that start date, local RLFs will be required to discontinue making new economic development loans. Currently, and up until that start date, you are still able to make new loans. Because there's that 2-year period that you can turn in your funds and potentially buy out your receivables, and we'll get to that in a bit. But the state will work with communities to determine the amount of funding in their closeout account. If you turned in things at the beginning of the 2-year period, that amount's going to be different than you did it 6 months in or 18 months in. And so you'll notify us when you're ready to do your returning of those funds back to the state, and then you'll complete a closeout report, which is very similar to your semi-annual reports you've previously submitted, along with those supporting documents, and we'll work to verify that balance. So the cash on hand, as well as potentially the loan receivable balance of outstanding RLF loans, will be paid back to the state within 2 years. Communities that cannot pay the outstanding loan balance or decide not to within that 2-year period. At the end of those 2 years, they will assign those loans back to the state. The receivable balance will not be held for the community to reuse, and the community will not collect or have claim to the balances. So at the end of the 2-year period, if you choose not to do the buyout, those funds will be assigned to the state, and the state will take over all collections and loan processing from there on out. The funds that are returned to the state, so both the cash on hand and potentially the buyout, will be held specifically for that period, or for that community, for a period of up to 2 years. Under certain circumstances, communities with large balances may be granted extensions to use the funds. So as we said previously, we modeled this program after Illinois. Illinois had a hard time frame of 2 years. In our submission to HUD, we asked for the ability to give extra time to communities with large balances, and we intentionally did not define what large balances were in order to hopefully give some additional flexibility for the communities. Our whole goal in this is, while trying to follow the lead from Illinois, because that's what's been previously approved and that's what HUD has told us to look at, but we're trying to work as hard as we can to make this as flexible as possible within the constraints of the program rules and regs, and make sure that the communities can utilize all the dollars that are turned in. So local communities can then apply back to the state for the use of funds for any eligible CDBG project for within the 2-year period. So that's the same 2-year period that you have to turn in the funds as you have to apply back for them. So if you're going to wait till the end of the 2-year period to turn in the funds, during that time you should be looking for those eligible projects and preparing to start those within that same 2-year period. Projects funded through CDBG close will need to be completed in 2 years from the time of application. So if you wait the full 2 years to turn in your funds and then apply back for them, you'll have an additional 2 years from that award date for your project to actually complete it. So it should be within a total of a 4-year period potentially that that funds and projects are utilized and closed out. So the RLF cash on hand bank balance, and plus potentially the RLF accounts receivables balance, will be turned into the state and will equal your CDBG close balance. Once the state receives the cash on hand and the receivables, any outstanding loans in the RLF portfolio would continue to be paid back to the unit of government and would no longer retain the federal identity. So then this is a big benefit for those communities that choose to buy out the loan receivable balance. So for example, if you had $200,000 in outstanding loans in your RLF portfolio, your community could find any source of the $200,000 to be paid back. Again, we don't care where the money comes from. If you're able to locate that in potentially a utility account for a project that those funds have already been set aside for, and that project may meet an eligible national objective and eligible activities, that's the easiest way. But if you find any source to pay the $200,000 back to the state, we will hold that with the cash on hand and grant it back to you for an eligible project. But you still have the $200,000 in outstanding receivables that are owed you by the businesses. And so you can potentially turn that $200,000 into $400,000. And again, once you do the buyout, those outstanding loans no longer retain a federal identity. And so what that means is at that time you could amend those loans to remove all federal requirements, and then any future repayments after that back to the local unit of government would be treated no different than any local revenue. They would have no state or federal restrictions on the use of the funds, entirely a local decision on how to use that going forward. So we understand this is a complicated process, and we did our best to create a flow chart here. So if you follow along with me, in the upper left-hand corner, you see UGLG. We call that UGLUG. That's all of you, that unit of general local government, so anyone that has a revolving loan fund. Top right is DEHCR, DECR, the Division of Energy, Housing, Community Resources. That's us. So an UGLUG would have the RLF cash on hand, plus potentially their loan receivable balance, and they would turn that over to us at DECR. We would receive the cash on hand and loan receivable repayment. We would create your RLFED closeout program, and then we'll send those funds back to you for those eligible CDBG projects. And again, expanding the reuse from just economic development to any eligible CDBG project. And then the lower left, you see that any repayments on those receivables after they are bought out are now defederalized. And it looks like we do have a question here. Does this include ED loans only or all of the outstanding RLF loans? This is all of the outstanding RLF loans. If you have an origination loan that we have made recently, which is only a couple, that is part of that outstanding receivable balance that you are owed. So that would be in addition to the local RLF loans that you have made. So here's a specific example of how this might work. So the City of Hope has a RLF cash balance of $250,000. Their RLF loan receivable balance is $350,000. So if they were going to buy out the loan receivable balance, the amount due from the city to the state would be $600,000. The city has a planned utility and street replacement project planned for next year that has estimated cost of $750,000. That in this case is going to benefit 51% or greater low to moderate income people. So it does meet a national objective and is eligible for the utility and street replacement. The city has $400,000 saved for this project in utility account and was going to borrow $350,000 for the street portion. So the city would file the $600,000 repayment with the state, and the state would certify that that's $600,000 available for the reuse on this project. And so the city will use the following sources to repay the state. They'll take the $250,000 in cash on hand. So that's just a transfer from your RLF bank account that has the cash sitting there. They're going to take the $350,000 in the utility account and use that as part of the repayment to do their buyout, and totaling the $600,000 that's repaid. So the sources of funding then for the street project are $600,000 from the CDBG close program. They still have $50,000 left in the utility account, and the borrowing is reduced to only $100,000 to total $750,000. So again, in addition, the City of Hope retains the future repayments of the principal and interest coming from the $350,000 in loan receivables. A potential use of the repayments would be, they could reimburse the city's borrowing of $100,000. They could reimburse the utility accounts in $250,000 plus interest, or, and this is a very common thing we're hearing that a lot of RLFs are interested in, they would use the repayments that are now defederalized to capitalize a revolving loan fund that has no federal restrictions. Again, so you could establish a new revolving loan fund with all your own parameters and rules and regulations. That could be still require job creation, but you could do your the amount per job at any level you wanted. You wouldn't have to do low to moderate income tests. You wouldn't even necessarily have to do job creation. Again, once it's defederalized, the state and the feds have no bearing on how those funds can be used. And it looks like we have another question. Do we have to wait the full 2 years before we can assign the remaining loans to the state? So if your community chooses not to, or again is unable to do the buyout, they will have to wait for that 2-year period to be able to return those or assign those loans back to the state, and then we will begin processing after that period of time. So a lot of communities have said to us right off the bat, we're not sure where we potentially be able to come up with those funding to do the buyout, or what eligible projects you might have. And that's where we see ourselves working with you in these coming months and years during this program. The easiest scenario, like I said, is instead of having to come up with a source to pay out, potentially borrowing or whatever the source might be. In this situation, the community with a revolving loan fund already had a eligible project that they had funds allocated towards. And so by taking those funds allocated and doing that repayment, we give it right back to the community for the same project it was already set aside for, and that accomplishes the buyout. and moves towards that potential doubling of the funds. So one thing that we're asking a lot of communities to do is, as we work together going forward, is take a look at what you might have budgeted coming up in the next year or two. Take a look at those items that may not have been currently budgeted, but are on the list of wants that you may not have funding sources for. And then we can work with you to look through that list and kind of determine what might be eligible, what might not be eligible, or what might need a follow-up. Maybe you do have to do that income survey going forward. But by you having and identifying those projects that you would like to do in your own community, it makes it a lot easier for us to work with you to really identify what is and what might not be eligible. So some of you may have attended the first webinar we did. That was at the beginning of June. And when the state does a substantial amendment to their comprehensive plan, we are required to have a 30-day public comment period. And so during that period, many of you submitted comments, and we did make some program adjustments to what the original presentation had included. And we just want to highlight those here. So the first off is RLFED is capitalized with only pre-1992 funds can be defederalized upon approval of closed program by HUD. And so kind of what that means, and we've had some questions, if we can identify that we've only been capitalized with pre-1992, and the big and here is, and have not received economic development funding after 1992, so it has to be both. You have to be capitalized pre and not have received additional economic development funds after. We still need approval from HUD as part of this program in order to defederalize your revolving loan fund. That does not happen separately. It is part of this submission to HUD, and so we do need that approval first. Number two is loan losses are not deducted from RLF closed account balances. We had that initially, where if you had, let's say $100,000 worth of losses throughout the history of your program, that you would turn in funds and we would deduct the losses from that amount. Based on the many public comments that were submitted, we have changed that. Loan losses are no longer deducted. Any funds that you do turn into the state, we will hold in an account for your reuse and grant back to you for those eligible projects. And number three, we increased the number of projects from 2 to 3 and added a planning project as an optional 4th project for RLFs that do buy out the loan receivables. So again, Illinois is very stringent with the amount of time and the amount of projects they had. We've tried to add some flexibility to really ensure that all the local communities are able to use their dollars going forward. And we do have another question. Will you be providing a worksheet for each municipality to assist in figuring out how much we need to repay? So we will have that closeout report that we're calling it. It's really going to be a modified version of your semi-annual report that you filled out in the history. And you should have a fairly good idea what that account balance might be. You're still currently able to make loans, so there's a potential for you to decrease the amount of cash on hand you have, but in general, I would say the majority of revolving loan funds are no longer going to make additional loans, and so you'd be looking at the amount of repayments that you're going to have, month to month. So if you plan on doing this right away, you should have a really good idea, because we might be starting in just a couple months now from when the repayment is. But if you're planning on maybe doing it in 6 months or 12 months, you should be able to look at what your current cash on hand is, what the amount of repayments are received during that 12 months from your outstanding loans, and you can have a pretty good understanding of what that total balance might be. But we will have that modified semi-annual report that we're calling a closeout report that you'll have to fill out, and again provide the backup documentation for us to verify that the final number might be. So again, to kind of summarize how we've gotten here, given the substantial amount of money in Wisconsin's revolving loan funds, the state has chosen to be proactive in seeking HUD approval to create the closeout program that not only reduces the compliance risk for both the state and local communities, but also gives greater flexibility to local communities to use the funding in the revolving loan funds. And so we think we've already seen an example of that reduced compliance risk by being proactive, by having a draft of this program available when we were monitored in May. We do think that already reduced the amount of findings. Now we haven't received the final findings letter, but we have been verbally told what those might be. And we do think that reduced those amount of findings. Again, having talked to Illinois, who's about 18 months into this program, their understanding and their experience so far, going back to when they started their monitoring from HUD 3 or 4 years ago, is that HUD has not gone and looked at the local revolving loan fund files, and it's a big thing we're trying to prevent. For having HUD show at your door and asking to see that verification of accomplishment data and all the other rules and requirements of federal program at the local level. And so we understand this is certainly a big change, but we do see the benefits and the potential to utilize those dollars that may have been sitting in your bank accounts for 5, 10, in some cases 20 years. Additionally, provide that broader scope of projects for the eligible reuse to use what was previously set aside as economic development funds for any eligible CDBG project where you might have infrastructure needs in your community or blight that you want to address, and this does allow that to be utilized for that. So it looks like we have another question that just came in. If you guys have additional questions, please send them in at this time. We'll certainly be hanging out. This is the last slide of the presentation, but we'll be here as long as people continue asking questions, and we'll hang around for a while. We do appreciate everyone attending, and we will be updating all people on our email list with any information we do receive back from HUD about the start date or any potential changes. Certainly feel free to give myself or Dave Polish a call if you have questions outside of this webinar. If you want to talk about something a little bit more specific to your community, you can either email or call us. We are looking to have in-person meetings with a lot of communities. If you think that's a need for us to sit down and go through, whether it's in person or by phone with members of your community to, again, help identify those and answer the questions you have, please let us know. There are 130 plus revolving loan funds. So as we schedule our time to go out throughout the state, we may not have a ton of flexibility of the times we are driving through, and so we'll work best to accommodate. But we certainly can communicate whether by phone or in person and answer those questions you might have. So again, we have a couple coming in here. October 1st is around the corner. What should we expect the start date to be for the closed program? So I think right now it would be November 1st at the very earliest. And again, unfortunately, this is kind of in HUD's hands now, and we're really waiting for them to turn around. And so it's really tough for us to estimate when that response will be made. I would hope at the very, very latest January 1st. But that being said, really the only thing that changes upon the start date is the fact that you're not able to make loans out of your revolving loan fund. That will no longer be allowed. But in terms of processing your repayments or looking for those future additional projects, nothing has to be done immediately upon the start date. You do have that 2-year period to continue moving forward. So again, a number of questions have come in, so we'll go through them. The village's money was pre-1992. How do we get approval from HUD to close out and get defederalized? And so we'll look at our records. And again, it seems like you have checked already, but we'll go through our records and check out your as well to verify that as the date. Again, that will be part of the submission, or it has been part of the submission to HUD, so we do need HUD approval. When HUD does approve our closed program, we are looking to do a certification form from your local government's chief elected official, basically stating that the fund was capitalized prior to 1992 and you did not receive additional funds, and we're just looking for a simple form that we do have a copy of. So we will be providing that, but we still need to wait until HUD approval to go down that road. We had to pay back $185,000 as a repayment in May of 2016. Is this amount taken into consideration? No, it's not. All repayments for, whether it's a previous agreement with the state in terms of repayment on a 50-50 basis or just turning over the over the cap amounts will not be included as a revolving loan fund account. It's just going from the start date in that 2-year period of when you choose to do the repayment is when we'll identify specifically how much you turn in and get back. Could you please explain how this scenario works for a municipality that has no outstanding loans? So we do have a couple that don't have any outstanding loans. In that case, you don't have the option to do the buyout. So it's a cash on hand turnover. You'll whatever time during that 2-year period you want to turn the cash into the state, you're able to. And we will hold that cash for you, and you can look for any eligible project in your community and apply back for it. So that one's pretty straightforward. When your community does decide to turn those funds in, you'll be eligible. And again, we'll work with you to identify what projects that might be able to go towards, whether it's a community center, senior center, street, water, sewer projects, Salmon Blight. Again, we'll work with you to determine that. But you can start looking at the projects you have either budgeted, and you could free up local dollars and use the CDBG dollars for, or maybe identify something that you haven't been able to fund in your local community that you do want to use your dollars for. Where do we get information on eligible programs, and how do we get started? So certainly the list of eligible projects that Dave went over earlier is not a fully exhaustive list, but it's pretty good in terms of what we normally fund. Certainly if you have questions about something that's outside of that standard list that is provided, please let us know. In terms of HUD's lists of what eligible projects might be, it's pretty much that. Although again, not every eligible activity is listed. So I'd ask you to, if that doesn't ring any bells of what might work in your community, to reach out to us, and we can have again a discussion about what's going to happen in your local community. Next question is, who do we contact for help in confirming the capitalized with pre-1992 dollars and have not received any post-92 dollars? That's Dave or I. We've done a preliminary check based on our records and can kind of go through that with you, but we do want the local communities to feel comfortable that that is correct as well, because you will have your chief elected official doing that certification. You do want to feel comfortable on your own end. So we do ask you to check your own local records, but if you want to ask the state what our preliminary checks might be, that's a phone call to Dave or I. If we are $500 away from our cap, should we return that money at this time or wait? You can wait in that scenario, yes. Since we are so close to the start date, you can hold those over the cap payments going forward and use that as the cash in hand to be sent back to you going forward. Is there any benefit to waiting on turning over either cash on hand or the buyout the cash in this in that situation? Potentially, specifically on the buyout of the cash, or excuse me, the buyout of the receivables. If you and again, I know a lot of budgeting is going on right now, but if you may have missed that or don't have the availability to do it in this budget cycle, we are asking that the cash and the buyout occur at the same time. So if you aren't able to find the resource to do the buyout in the first year, it may make sense for you to still have that option and just do it a year into the project. During that time, identifying those projects for the reuse. But it's kind of at your own speed. Again, you don't have to turn in your cash right away. You could wait to have that project, or you could do it right away and we'll hold it for you for that period of time and you work during that period. It's going to be a kind of a local decision. But again, it may make sense for you if you don't have the resources to do the buyout up front, to maybe wait till that 12 or 18 month period to go through that. You will send us the information about 1992 after HUD approves. Yes, so we're looking to again, double check all of our records. We're asking you, local units of government, to do that as well. After we do hear back from HUD, and it might not be an immediate approval. They could have some tweaks to the program. Well, we'll certainly let everyone know if anything's changed and how to proceed, and we'll be hosting additional webinar sessions to go through filling out paperwork, applying back, and so we'll be in contact with all of you as much as possible to how all this works, and certainly you don't need to wait for another announcement of a webinar. If you do have questions, feel free to reach out to Dave or I, and we can try to answer that for you as soon as possible. There are not currently any additional questions in the queue. We will certainly hang around here for a while longer, and I take that back. 2 more just popped in. Did I hear correctly that the PowerPoint will be sent to us over email? Yes, you did. We will be sending that out. I'm not sure if it'll be this afternoon, but I'd say hopefully by no later than tomorrow. Are there any match requirements for projects such as road construction infrastructure? So that's the one big benefit about this program is unlike our competitive public facilities or other programs that we do, there are no match requirements to using your RLF closed dollars. Another benefit that I think I forgot to cover, when you're doing your closed projects, you're identifying eligible activities in your community. And by identifying those eligible activities, that means you could also be eligible to apply for our competitive program. And so our competitive public facilities program, let's say you're going to do a street water sewer project on a couple blocks, those applications are due in May of each year, and those have a 1-to-1 match. Now, if you have CDBG closed dollars and you're also awarded a public facilities grant applications are due in May, awards are generally in August, you can use your closed dollars as match for our competitive program. And again, use even more non-local dollars to complete those projects in your community. So I'll say that one more time. If you are awarded a competitive public facilities project, during that next application or the one after, again, that would be applied for in May with awards due in August. You could use your CDBG closed dollars as match for that, and again, utilize additional funds that aren't local dollars. There's another question here. With the 2-year project ID period, does this work like other CDBG programs where everything has to be applied for and approved before there's a bid or a shovel in the ground? Could a community miss the period by having a late bid date? So when you're talking about the first 2-year period, when you're looking to identify those projects for reuse and turn in the funds, so we will need to have that application for the reuse of funds within that period. Although, as we covered earlier, we may have some flexibility for that, depending on what HUD replies for. Once the award of that reuse funds, that will trigger the use of those funds. We'll have those allocated and set aside. So even if you don't do a bid until a little bit later, that won't be an issue. So it's just the application date will trigger, and then you'll have that 2-year window, additional 2-year window after the award date to complete the project. So on that late bid, again, wouldn't affect the reuse of the dollars as long as the application's done within that 2-year period. You would just have to fit it into the 2-year construction window that we generally have. What does the term capitalized before 1992 mean? So how all of your revolving loan funds, or I think most of all your revolving loan funds were established, is that your unit of government at some time during the 70s, 80s, 90s, or 2000s applied for what we call an origination grant. So the community applied for a grant from the state. The state granted those funds to your local unit of government. The local unit of government made a loan to the business, and upon the repayment of the loan from the business back to the local unit of government, your revolving loan fund was established. And so that's what we consider to be the capitalization. So if those awards from the state, that initial capitalization of when your RLF was created, occurred prior to 1992, that's how you'd fit in that category. So we, again, the CDBG program goes back, I believe, into the late 70s. So we certainly have many communities that were capitalized in the 80s or early 90s. I'm not sure if we do have any that go back as far as the late 70s, but we have many that have been more recent since post 92, the 90s even to the 2000s. So you have to go back and look again at when the start of your RLF occurred, when that original grant from the state was made. And then the second key for the defederalized is that you couldn't have received an additional grant since 1992. So it's the 2-part, have to be established pre-1992 and not receive an additional, and it's just an economic development grant. You could have received a public facilities or a housing. It's just economic development that would trigger the non-defederalization if you started prior to 1992 but got an additional project. So no additional questions at this time. Again, feel free to sign off anytime you'd like. If you do have additional questions, feel free to type them in. Again, we'll be hanging here until we do see that many people have signed off and there are no additional questions coming in. Feel free to reach out to us outside of this period as well. Thank you all for attending. We did have a question that says, can you provide some of these questions and answers in a fact sheet? Yes, in fact, we do have a draft FAQ form that we are looking to post on our website shortly. It's been drafted for a while, but with some of the changes during the public comment period, we hadn't posted it yet. So yes, we'll get the PowerPoint emailed out to you, and either of those frequently asked questions emailed or posted on our webpage. Thank you. So we do have one more question that came in. It is, with the current flooding situation, can those communities declare certain areas as blighted because of the flood damage and use these funds to help with that? So that's a very good question, very timely for many communities throughout the state. Our blight definition is using the state definition. So I think generally the answer to your question would be yes. If you follow the state definition and blight your properties, then that could deem them to be assisted under the CDBG program. So again, if you're not familiar with the state blight definition, take a look at that. I think it's fairly user-friendly in order to, again, designate blights. But yes, that could be a possibility for your community. And again, looks like we have about 10 attendees left. And we did get another question. If we currently have a business with a final balloon payment due December 31st, but they want to extend or refinance it, is it allowed at this time? Why don't you contact us, and I think we're going to look at this on a case-by-case basis. It might also bring in what you're intending to do with a buyout potentially, or turn over the outstanding loan to the state after 2 years. So Amy, if you could reach out to either Dave or I, we'll talk about that with a little bit more of the background to it before we can give that answer. So again, there's about 10 attendees left. We'll hang out here for a few more minutes. If you don't have any more questions, again, feel free to sign off or contact us afterwards. Thank you. We haven't had any additional questions come in. Looks like there's only 5 of you left, so we are planning on signing off at this time. Again, if you do have any additional questions, please reach out to Dave or I. Thanks for attending.